Hey everybody, it's James Knoll here, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a more secure retirement. Now, Roth IRAs are one of the best types of accounts that you can own. Any money that you invest in a Roth IRA grows tax-free forever. Anything you pull out of your Roth IRA in retirement is completely tax-free. Roth IRAs aren't subject to required minimum distributions. Roth IRAs aren't included in Social Security provisional income tax calculations. There are so many benefits to Roth IRAs, the list is endless. Unfortunately, the IRS says that if you make too much money, you can no longer contribute to a Roth IRA. And when you can't contribute to a Roth IRA, you're forced to use other types of accounts where you are either taxed on your growth or taxed on money you pull out. Fortunately, there is a way around this, and what I want to talk about today is how you can still make a contribution to your Roth IRA even if your income is above certain limits. So what we're looking at here, these numbers are for 2021. This shows Roth IRA eligibility. So if you are single and your modified adjusted gross income, and think of modified adjusted gross income as roughly being your gross salary minus any 401k or 403b contributions that you're making. So your modified adjusted gross income, if you are filing taxes as single, if it's under 125,000, or if you are filing your taxes married filing jointly and your combined income is less than 198,000, you can make a Roth contribution. You don't need to worry about the rest of this video. You can just contribute right to your Roth and there's no problem. But if you're single and your income is over 140,000, or if you're married and your combined income is over 280,000, you're no longer able to make a Roth IRA contribution. And if your income is somewhere in this range, you can do a partial contribution. You start being phased out the higher your income gets. What we're going to go through though is for those of you who are single and have a modified adjusted gross income that's higher than 140,000, or for those of you that are married and have a modified adjusted gross income that's higher than 208,000, how can you still get money into a Roth IRA to take advantage of the incredible tax benefits that they offer? Well, here's how we're going to do that. You're going to do something called a backdoor Roth conversion, but there are a lot of rules to this. So absolutely make sure to stay tuned to the very end of this because this does not work for everyone and there's some things that really trip a lot of people up. But here's how it works. There are income limits that we just looked at. So if you want to contribute to an IRA or to a Roth IRA, the contribution limit for 2021 is $6,000. If you're 50 or older, it's $7,000. But if you are making more than these limits we just looked at, you are not allowed to put money into your Roth IRA, nor are you allowed to put money into your traditional IRA and have that contribution deductible, meaning you're not able to deduct any contribution to a traditional IRA. So right off the bat, you're not able to do this. And it makes it look like, oh shoot, well Roth IRAs are for someone else, but not me. But the concept of the backdoor Roth conversion, what that is instead of taking your contribution and putting it into a Roth IRA or putting it into a traditional IRA that's deductible, what you do instead is you contribute that to a non-deductible traditional IRA. Meaning because your income's over a certain limit, you do not actually get to take advantage of the tax deduction for putting that money into the IRA. Now, because you weren't able to take any tax deduction for making the contribution, if you then immediately convert that non-deductible IRA balance into your Roth IRA, you're essentially converting an after-tax dollar, or 6,000 after-tax dollars, into another after-tax account. So unlike a pre-tax IRA that was maybe a traditional IRA contribution that you deducted a while ago, or maybe a 401k contribution that you then rolled over to an IRA when you switched jobs, if you were to convert that to a Roth IRA, whatever amount you would convert would be fully taxable. But because you never took a deduction for making this traditional IRA contribution, you can deduct it and there's no taxes on that conversion. So what you're doing is it's taking you two steps to do what you could ordinarily do in one if your income was under certain thresholds. So it seems simple enough. What you do is you open up an IRA, contribute to the IRA, no tax deduction taken, and then turn around and convert it, then invest the funds in your Roth and everything's good. But there are some details, like I said, that trip people up and that get people in trouble that I want to go through now. Let's say you're watching this video and you say, this is awesome. I already have another traditional IRA over here, but I'm just going to open up a new traditional IRA to make this non-deductible contribution to take advantage of the backdoor Roth conversion. Well, if you do this, and I'm going to make some assumptions just to use easy numbers, Let's assume you have a $24,000 pre-tax, so an IRA where you took a deduction on somewhere else. So you already have that account, it's fully funded, it's doing its thing. But you want to do a backdoor Roth. So what you do on the side is you open up a separate IRA and you make that after-tax or that non-deductible contribution, so you now have $6,000 in this non-deductible IRA. Well, you then go to convert that to your Roth IRA so that that money can be filtered or funneled into your Roth and grow tax-free forever, but the IRS does not see it that way. The way the IRS sees it is they have what's called an aggregation rule. They're going to look at everything here. And what that means is they're looking at you and really looking at it as if you have one big $30,000 IRA, or one $30,000 IRA, of which 80% is pre-tax. So the 24,000 divided by 30, so 80% pre-tax, and 20% of it is after-tax with this new non-deductible money that you put in. Well, if you then go convert just $6,000 to your Roth IRA to do the backdoor Roth conversion, 80% of that conversion is actually taxable because 80% of your aggregate IRA is pre-tax. The 20% that's after-tax, well, 20% of that conversion is non-taxable. So what you end up happening is $4,800 of that $6,000 conversion, so 80% of $6,000, is taxable. And you owe taxes on it, which is what we want to avoid. Only $1,200 of that conversion is actually tax-free. So what do we need to do? We need to get rid of this IRA. How can you do that? Well, there's a few ways. If it's a small enough IRA, say it's only a couple thousand, few thousand, and by the way, talk to your tax planner, talk to your financial planner, all the disclaimers and disclosures with that. Do not do this until you talk to a CPA or financial advisor, someone that knows exactly how this works. But if you have a small enough IRA, you could just consider converting that. Convert that to your Roth IRA just so that you no longer have any traditional IRA assets, which frees up every subsequent year for you to now begin making these backdoor Roth conversions. If you have a pretty significant balance in here, let's say you have $1 million in your IRA, you probably don't want to convert that all at once. That's going to lead to a very significant tax bill because the IRS is going to look at that and treat it as if you earned another $1 million in this year of ordinary income, which is going to be several $100,000 in taxes. We want to avoid that. Some workarounds. If you have a 401k at your current employer, most 401ks will allow you to take any pre-tax balance you have here and move it into your 401k. What that does is it clears out the IRA balances that you have, and you still get to have that money invested. It's still pre-tax. It's still money that's accessible down the road. It's just in a 401k, not in an IRA. That's one option. If you're self-employed, you can design a retirement plan that works for you. So you could create your own solo 401k potentially, assuming it's a legitimate company that you have. You could create your own solo 401k and roll that IRA into your 401k. So there are options here, but the goal is you want to fully get rid of this. You do not want any pre-tax IRA assets. Otherwise, because of what we're looking at right here, it just gets in the way of making a tax-free conversion and allowing us to do all this. But if you do not have any IRA, or if you're able to roll it over to your 401k or some other retirement asset that's not a SEP IRA, a simple IRA, or traditional IRA, then this process here is how you can get money into your Roth IRA. Now, in summary, the 3 important things I want you to take away from this. Number 1, if you're going to do this, make sure you have no pre-tax IRA assets. This includes traditional IRAs, this includes simple IRAs, and this includes SEP IRAs. If you have any of those, the IRS is going to aggregate those and view it as one. So when you make those conversions of the after-tax or non-deductible contribution, it's not just the non-deductible portion that you're converting. A couple things to note with that. Number 1, inherited IRAs are not counted towards the pre-tax IRA balance, which is nice. So say, for example, someone passed away and you inherited their IRA. That's an account you can't move to a 401k. You can't really do much with it. It has to stay there. But thankfully, an inherited IRA is not counted towards a pre-tax balance. The exception to that is if you inherited the IRA from your spouse, your deceased spouse, and it's now just an IRA in your name. If that's the case, then it's treated as a traditional IRA, not as an inherited IRA. Number 2, the second thing to note is maybe you don't have any traditional IRAs, but your spouse does. And if you're looking at that and saying, well, does my spouse's IRA or does their simple IRA or SEP IRA impact my ability to do this? The answer is no. it would impact their ability to do this backdoor Roth conversion based upon the steps that we're working through, but it would not impact your ability to do it. So instead of you and your spouse both being able to do a $6,000 backdoor Roth conversion, or $7,000 if you're both 50 or older, just the one of you could if one spouse didn't have any traditional assets. Step 2, fund the non-deductible IRA and look to convert it immediately. Some people ask, they say, okay, well, should I start saving monthly to this IRA knowing I'm not going to deduct any of those contributions so I can invest it along the way and then convert it to a Roth once I've made the full $6,000 of contributions? Ideally, you don't want to do that, because when you do this backdoor Roth conversion, if you put $6,000 into your non-deductible IRA and then you convert it to your Roth IRA right away, there's no taxes due. There's no taxes owed. But if you make a $6,000 contribution and say, for example, you invest it and you invest and it grows to $8,000, and by the time that you convert it to your Roth IRA, you're converting $8,000, well, that $2,000 of growth is fully taxable, and only the $6,000 that you put in is tax-free. So ideally, we want all the growth to happen in the Roth IRA. We don't really want any growth in the IRA. We just want that to be a funding mechanism so we can put money in, have it converted, invest it, and reap the benefits of that tax-free growth forever. And then finally, step 3, you must remember to file Form 8606 with the IRS, because what that does is it reports to the IRS this contribution that you made to your IRA, you're reporting it as non-taxable. You're saying to them, I don't want to take the deduction for this contribution, so that when you make the conversion, they're not looking at that as a taxable conversion. They're looking at it as something that's tax-free. So I hope this is helpful. Again, make sure that you talk to your CPA. Make sure you talk to your financial advisor. This can be a great strategy to get money to Roth accounts, even if your income is too high. But I do want to make sure that you're going through the right steps to do so.
Thanks for watching. Again, this is James Canal with Root Financial Partners. If you think of anyone who could benefit from the advice in this video, please share this with them. I would love to get this in front of as many people as possible. And if you're enjoying this content and would like to see more like it, please make sure that you're liking this video and also subscribing so that you're notified anytime a new video comes out. If you want more great information about how you can create a secure retirement, be sure to tune in to the Ready for Retirement podcast. And finally, if you're interested in services that can help you to create that secure retirement, please be sure to check us out at rootfinancialpartners.com.